All right, welcome back. Today we're talking about rates in 2026, what we can expect, what the core drivers are, what the wild cards are, and what this means for you.
And
Oh yeah,
branding.
We're leveling up. We got some cool new hats. We've been spending some time on it with some merch. So stay tuned for some more on that.
This is the Loans Elevated Podcast, your weekly dose of market insights, financing strategies, and all things real estate. Presented by the Lassig Team, a top 1% nationally ranked mortgage team.
Everyone tries to guess what's going to happen with the market. But in reality, we've tried guessing for years, and it's never pans out exactly what we thought. And everyone's expecting this year to be more of the same.
Mm-hmm. So you can probably bank on the fact that it won't be the same.
Exactly.
That's
Yep, exactly. But the big picture right now and the core drivers are, of course, number one, and this is the tale of as old as time, is inflation, which we know. And we constantly hear the Fed talking about inflation. We hear about it on the news. But more importantly right now, which I think I hear more of, is jobs numbers. Mm-hmm. Wouldn't you agree? Mm-hmm. And we're getting some jobs numbers this week, actually. And the tale of all this time is jobs numbers have not been accurate, or they go and they're revised, and the market does not move accordingly. It moves based on the headlines, not on the revisions.
Right. For sure. But you know what's interesting, though? This is an unproven theory, but it's just my own opinion, is maybe we are in an economy that has evolved and is evolving so quickly that these standardized metrics, the baseline is changing for a multitude of reasons. The economy's larger than it was. COVID created dramatic changes that were hard to even keep up with.
Right.
And at the same time, a lot of the reporting was not accurate. Mm-hmm. But now you have this other component of deportations. Yeah. And so we have fewer people working, and so now the employees that remain are more valuable to these employers. Maybe not all of them, right? Because some of it probably didn't affect every industry the same. Mm-hmm. But it's like, what I think we're seeing as like a trend, if we're looking from the outside looking in, not economics professionals or whatever, what we're seeing is people, like, nobody's really hiring, and nobody really has been hiring for, like, no one's been in growth mode. Any of our clients, anybody in the industry, growth mode has not been on for years, but nobody's actively laying people off either.
Yeah, when we kind of talked a little bit about this yesterday too, growth mode can be something different this year than it was even last year because of AI. You can grow in ways that without hiring people.
So you have COVID that just smacked us all in the face, and it was kind of like, it's like when you hit your head or you get punched in the face or smacked or something like that. It takes a minute to be like, get your footing again and realize, like, what the hell just happened? Yeah. I think COVID was like that for multiple years, and there's a lot of like amnesia or like we don't even know what happened. And then you cap on deportations or immigration policy, and then you stack on for around the same era this effect of AI, and it's already having impacts. Like our business, we're leveraging. We have less staff and bandwidth invested into the little bit of marketing work that we do as a team because of AI.
Yeah, it's true.
Like, we're just now getting ready to grow and hire somebody else, but because of AI, our master
and we've stretched bandwidth to the max from AI too,
and grown and been able to keep going.
And we're closing more units because of it.
Right. So from a marketing standpoint, from a production standpoint, it's crazy. So there's all these facets, and so I think, like, what the market is paying attention to is maybe like antiquated expectations or antiquated baselines that aren't real markers of what the economy's doing.
Yeah, which is a perfect segue into the next thing, and when it relates to housing, which is economy. And we always said that, as rates come down, we expect to see more and more buyer activity. But the fact is, rates have come down a good amount over the past year.
Like 2 points.
And we haven't seen more buyer activity. And that's because there's so much fear. The fear and greed scale, it's all the way onto the fear side, which is interesting. And it's gone to show that fear freezes the economy.
It is weird. So are you saying that there's uncertainty about the future? Like, because I've heard some stats just anecdotally. I haven't really investigated this big at all, but there are people that don't feel confident in their job security and the future of income and so on. So is that what the fear is?
Exactly. Yep.
Which is all related to AI and also immigration policies.
Which in turn puts a slowdown on the housing market.
Right. Yeah, because people don't want to make a decision. But I am seeing, like with rates lower, we are for sure, like the conversations are heating up. People are talking, like real estate is getting sexier again.
Yes, most definitely.
Slowly and surely.
Yes. People are slowly coming out of the woodworks. They're ready to start game planning. Yeah. I get texts left and right now. They're like, hey, now that rates are on a good trend, let's start game planning on what a refinance means for us, or I'm planning on selling my house and want to upgrade. Because let's face it, COVID now has been 5 years since 2020. 6 years. 6 years since 2020. You've outgrown your house. The average, well, and this is a little bit dated, but in previous markets, the average consumer was moving their house every 5 to 7 years. Right. I think that's closer to 10 years now, maybe because of COVID.
Probably.
But
because that falls right in that.
The household has to be outgrowing their household, or maybe they need to downsize. One
right. Something, or they are sick of their commute, or things have evolved. Yeah, that's crazy. I was going to say something based on what you were. Oh, what I was going to say is, part of me, we've said as rates come down, what we've said multiple times is as rates come down, it's expected that 50,000 new home buyers come into the Utah market. Yeah. Every 1% drop in rates. Rates have dropped about 2%, nearly 2%. So we'll just say it's like, theoretically, there should be 90,000 more buyers in the market. We're not necessarily seeing that flood, but I guess now I'm starting to think in this conversation, like, is the slingshot being pulled back? And those 90,000 are there waiting, and then boom, it's just going to be a flood.
And the part that scares me is that building is dramatically slowed because the demand has slowed.
Yeah.
So when all that demand comes at once, we could run into some inventory
issues.
It's
a COVID repeat.
Exactly.
Which hopefully, I don't know. Hopefully that doesn't happen.
Hopefully it's not as bad because rates won't be that low.
Well, and what I was going to...
You're not going to have the... Sorry to cut you off, but we're not going to have the people that are just moving just to move because rates are low.
Right. It's not rate engineered, for sure. And what I was thinking through is like, what has always been the case. Now, we've capitalized on low rate environments. And we've capitalized on high equity environments in our business. Like, we are definitely promoting these popular sentiments to stimulate business. We are doing that. But in the end, like, in the root of what we do, and we've said it when when home prices were not going crazy, when rates were normal, when rates were low, when home prices were going crazy, when rates were high, in all the environments, we've always said one thing. And the one thing is, no matter what, buy real estate. The best time to buy real estate was yesterday. If you didn't buy yesterday, buy today. If you can't buy today, buy tomorrow. Like, that is the thing. And it goes to say, like, stop paying attention to rates, and people really need to... that's one thing that I feel grateful that we've learned as advisors, is we stuck so heavily on, like, trying to forecast rates, trying to forecast and guiding our clients based on that. And the reality is, it's like, it doesn't matter. Buy right now, make it work, strategically get your finances in check, because you will be grateful. Last year we look at...
You're not going to regret it.
No. Last year you look at home prices, they went up like probably about 5% here in Utah. Now, granted, some neighborhoods, if you bought a new construction neighborhood where a builder was desperate and had to slash prices, then that little neighborhood might have lost value.
There's going to be micro markets everywhere where it could be down.
That's not what we're talking about. And you got to be willing to take that risk when you're buying new construction. We've talked about this too. But,
and let's be honest, if you have the client that's wanting to buy and look at selling the next year anyway, we're going to tell you not to buy.
Perhaps, or plan. You
shouldn't be a short-term thing.
You shouldn't sell.
Right, exactly. Yeah,
You shouldn't be trading. If you only plan to live there for a year, I probably would still say you should buy, as long as we have a clear plan on you retaining that property. Yeah, exactly. You need a good exit strategy. But 5% appreciation in Utah, in the most depressed housing market in 20 or 30 or 40 years. Well, 5%, dude, like the average house is what, 600 grand in Utah? So that means in one of the worst markets, homeowners in Utah, the average homeowner made $30,000 just by owning their house.
And that's on 5% on the home. That's not what they have into the home. The ROI is insane on that.
Well, chances are they only have 30 grand cash into the home.
Exactly.
Make 100% return on
Exactly. That's a no-brainer. And if you're looking to invest and park your cash anywhere, might as well park it in a primary home if you don't own one already.
Yeah. I just met with one of our team members today, thinking about upgrading their home. And I basically said that exact same thing. The best investment in real estate that exists, because I asked, like we go over, what are your real estate goals? And she's like, well, I just want the, quote unquote, forever home. I'm like, awesome. Do you plan on owning other real estate at any point in time? She's like, maybe we might buy some investments or something like that in the future, but it's nothing big. And I just closed that part of the conversation with some reassurance to her, and kind of a testament to what I believe, which is the best real estate investment you can possibly have is your primary residence. You can't have a better one as long as you do it strategically, right? You don't want to sit on the primary residence from an investment standpoint. You don't want to sit on that primary home forever. You want to be able to trade that tax-free, upgrade, let that money grow for you. Like you're saying, pay off debt, reinvest elsewhere. And it is the most secure and proven path to wealth in America, in my opinion, is buying trading primary residence real estate.
It's proven time and time again. And if you don't have anything set up for a primary residence, just meet with us. It's not like we're not going to jam it down your throat, but we're going to at least help you come up with a plan on why it matters and what it means for your economic future.
And maybe bust some myths that you either have formulated yourself or learned from other people, like you should pay off your primary home, or, like this quote unquote forever home. Sometimes you have to somewhat emotionally detach from it, because it's like what we're saying. And I don't know, this is maybe way off topic, but just to quickly put, if you want to riff on it further, fine. You can get $500,000 as a married couple in tax-free equity on your primary residence. So why don't you buy the nicest primary home you can afford, and when you make 500 grand, sell it, cash out, pay off any debt you've acquired, reinvest some strategically for retirement, capitalize on some and put it on a down payment on a new house, and then make $500,000 in profit again, and then sell it again and take that 500 grand. I mean, if you did that, like, you would be a multi-deca millionaire within a standard, like, work life. From working from 18 to 65, you would probably be worth tens of millions of dollars.
It creates generational wealth. And I think that's a huge misconception. I'm glad you brought that up, because people think, when I sell a house, I just need to take all the equity from the sale and apply it towards the new house. No, capitalize on the tax advantages from earning that, treat it as income, put it away into other investments, have it working for you, and then purchase a nicer, upgraded house and compound and repeat.
Yeah. And this is the backbone of holistic mortgage planning, which is what we do and how we, guide our clients through the process. But even just paying off debt, you're like, we want to upgrade, but we don't feel comfortable, payment. We only really want to spend like $3,500 a month because of X, Y, and Z. Like, I'll give you an example.
In a mortgage, yeah.
A client I met with recently, they said, I only feel comfortable spending $3,500 a month. I've got 130 grand in equity. I'm like, all right, well, what if you took that 130 grand, a portion of it, and paid off 35 grand to pay off that car that you have? That saves $400 a month. In that case, could you afford $3,900 a month?
Yeah.
They're like, yes. And then they go to continue talking, and they're like, over the next 2 years, this is where I'm like, not sure if this is the right time, but over the next 2 years, I have to pay $1,500 per month in childcare for my kids. But in 2 years, they're going to both be in full-time school and public school, and that cost is going to go away. So that $1,500 a month, I'm like, I might just have to wait 2 years. I was like, all right, well, you got 130 grand, 35 grand went to pay off the car. Now we still have 95,000 left. If it's costing you $1,500 a month for the next 24 months, let's just throw $36,000 in a money market account, which is the $1,500 per month for the next 2 years, prepaid in the bank. It doesn't come out of your pocket. 36 grand. So now we've got like what, 60 grand left to invest in other things. So we paid off the debt. Now sold the house, paid off the debt, funded the daycare expense. They went from being able to afford a $3,500 mortgage payment to a $5,400 mortgage payment, and the same exact freaking financial like their cash flow monthly did not change. But $2,000 a month, you can afford what? What is that, like an extra? What is $2,000 a month in a house? Hundreds of thousands. 320 grand more in a house. Yeah. So we just solved for them.
You're
to
living
buy
in a dramatically nicer house.
Well, and now check this out: 320,000. Let's just say that it appreciates at the same 5% as it did last year.
Yeah,
320,000 times 5%. Because they were just more strategic with the way they spent their money. They buy a same exact cash flow situation, same monthly payments. Mm-hmm. They made $16,000 per year in extra wealth, which is $1,300, $1,400 per month in free money.
Well, and that also you're paying more interest on that, which you can write off.
Exactly. Yep. So I went through that whole thing with them too. And they're making like an extra $350 per month net income with the tax savings. Mm-hmm. It's just like, if you understand this and you're willing to be unemotional about it and make decisions that are strategic and thoughtful, who the hell cares what rates are going to do? Who cares what the forecast is?
Yeah, it's more than the rate.
Who cares?
Mm-hmm. It goes to show that a structure is way more important than a rate at the end of the day.
Structure, strategy, an advisor. Because the fact is, you and I can't make that same decision as ruthlessly about our own household and our own family's money as we can for other people, because we're detached. We can be just super pragmatic.
Well, you and I will even riff off with each other on our own
100%.
situations.
Yeah.
It's just so hard. It's fun. Like you just said, we were just talking with one of our team members.
Yep.
Who does this all day, every day.
Right.
And it's like,
they literally see all the clients that we guide and all the whole strategy and the plan.
Yep.
They're still nervous as hell.
Yep. Sometimes you just need that different perspective.
It's crazy.
But let's dive into the wild cards. We went over the main driving factors, which were, of course, number 1, inflation, number 2, economy, and number 3, housing. But wild cards that you need to keep an eye on. Number 1 is the Fed tone, their messaging, not their moves.
And is this even a wild card? This is just like...
That's true.
This is the deck of cards that most people are missing.
Mm-hmm, exactly.
Like,
it's not what they say. It's not the headline announcement that comes out and how
it's
much.
Not if they drop rates or if they don't.
It's what they say in the meetings and the tonality of it. That's what's going to be moving the rates.
Well, and the crazy thing is, it can be, hey, they removed this one word in that sentence. Like, we expect employment to continue its path, or we are uncertain on the path for employment. Like those,
that investors will go nuts over that one
different
word.
Thing. Yeah, it's crazy.
You know, it's true. What I can say is the overall tone right now is that the current administration wants to get their person in and lower rates.
It's happening.
Yep.
Like I mean, it's based on the path. Yeah, it's happening.
So that's one thing to keep an eye on. Next is liquidity with the Fed. They won't call it QE, but let's face it, it's QE.
Pumping money into the banks, pumping money into the bond market.
And when they pump money into the bond market, that generally means that rates are coming down. Who's to say that, and the amount that they are pumping in is not what it was during COVID. Nowhere near, but it's not QT.
Right.
So that's always a good sign for rates.
And a couple of years ago we did a market update, and we talked about the changes the Fed makes, whether they're tightening or easing on the economy, and we're coming out of a tightening phase and into an easing phase, like you're saying. It takes something like 14 or 15 months.
Yeah, there's like a baking period
to feel the full effects of the moves they make. So that means the rate drops they're making today, we're not going to feel until spring of 2027.
I'm glad you said that, because we're just barely feeling the effects of the rate hikes.
Exactly. Like the rate hikes just recently peaked on their effects.
Yeah.
And now we're lagging behind where the effects of the relief we're not going to feel. So it's like I guess the wild card here is, do they have to come in with some parachute money? Like they're kind of doing some things now behind the scenes and not fully calling it quantitative easing, but maybe that changes.
Yeah, no, it's true. And then lastly, and maybe this is more of a moot point than it really is, geopolitics, conflict with other countries.
The biggest thing. It's the biggest wild card for sure.
Because this whole Venezuela thing that happened recently had less impact than I thought it would on rates.
Right. Right. Yeah, I agree.
I thought you would have told me that last year that there would be some conflict with Venezuela. I'd be like, dude, rates are going down.
Yeah.
But slight to no movement.
Yeah.
But then who's to say that doesn't flip on its head next week?
Well, there's a lot of stuff going on,
Mm-hmm.
and things can change fast. Like Russia and China are not real happy with
Mm-hmm.
the U.S. right now. I mean, that can change on a dime.
Yeah.
And I don't know. I mean, we need to do some research on this because I've been kind of pondering it, but haven't really dug my head into this topic yet. But like, why the Venezuela thing didn't have an impact? I just think it's because it was such a contained thing. It was a big deal.
Mm-hmm.
Like everyone was like, "Wait, we did what?"
Yeah.
Like that's insane. But there's certainty. It's like, okay, we captured this guy, and that's that.
I think that was cute. You just said there's certainty.
Yeah.
Mm-hmm. Because if there is further uncertainty in geopolitics, that could put more of a freeze on the real estate game.
Oh, 100%. Risk off trades.
Mm-hmm.
You're going to see stocks sell off. You're going to see bonds get purchased,
Mm-hmm.
which means mortgages are going to get purchased. Like, it's when there's uncertainty or there's like, okay, you know, and we're kind of getting there. Like, Russia just sent a submarine today. We
Mm-hmm.
just seized a Russian flagged ship today. Like,
Yeah.
there's a couple big things that happen, and like, one of those things could be the straw that breaks the camel's back, where it's
Mhm.
like the markets just throw their hands up and it's like, all right, we're not prepared for this. And risk off just basically means they're pulling their money out of the risky stuff because they don't know how the markets are gonna change, how businesses are gonna react, and they throw it in stuff that is more simple. Like as a household, what we might do is take our money out of Tesla stock and throw it in the money market account. If we're fearful that Tesla stock may not perform for some reason, or name your stock, doesn't matter. I'm just saying that as an example, but that could happen at the drop of a hat. And geopolitics really, in my view, that is our wild card.
Yeah, I would agree. And as a homeowner, if you already own a home, what I think this means for you is if rates do continue to go down, that doesn't mean you need to wait for the absolute bottom of rates to refinance. You can refinance in steps. Now, what it's important to realize is your break-even period. You don't want to be refinancing, buying down your rate dramatically, and put out your break-even years. What we'll do is even months. What we'll do is help you analyze what your break-even period should be for your exact situation. Oftentimes 2 to 3 months right now for most families.
I mean, I would say almost every refinance that I've personally been a part of lately
They're
has been
breaking
an
even by the time they make their first
instantaneous
payment.
break even.
Same here.
You make your first payment, done. You made all your money back. So that means if you refinance again next month, no harm, no foul. Like that is the strategy because we know rates are going to keep coming down. They're not at their terminal low point.
No.
My opinion is we're not really at our low point until they drop, like until you're able to get a rate, maybe not for free, but until you're able to easily buy a rate into the sub 5 range. I think we're on a path downwards, which means rates probably sit like in the 5% era. And then maybe you buy down to mid 4s, maybe even high 3s, something like that.
Especially
possibly.
if it's a house that you're going to be in long term.
Right. So the whole strategy could shift. And the reality is, like during COVID, we were massive, huge proponents of rate buy downs.
Oh, yeah,
rate
for
buy
sure.
downs.
Because, I mean, if you had rates in the mid 2s, you could buy down to 2% flat. Easy.
Or even in the 3s, you could buy down into the 2s, and you knew you were never going to change that mortgage. Like people that are buying these properties, we knew that, like, okay, maybe it's a 3-year break even. Who the hell cares?
Yeah.
It's almost
in 2023
guaranteed.
they're laughing.
Yeah, it's almost guaranteed you're going to be in that mortgage for 3 years. So do it, right? And so yeah, it's not a number thing. It's not a payment thing. It's not a dollar thing. It's purely a break even thing.
Yeah.
Cost you this, you break even this quickly. Statistically, are you going to be in that mortgage for that amount of time to make the money back? Right now, the answer is basically no if you pay any fees on a refi.
Yeah. I think to summarize, 2026, in my opinion, will reward readiness. The people that have a plan, that are ready, that know there could be some volatility like we've seen in previous years and are ready to roll with the punches rather than waiting for a perfect window, those are the people that are going to win.
I think a different way to say it, and maybe a little bit different statement in itself, is those who execute.
Yeah.
Like, just do it. What the
Exactly.
hell are you waiting for?
Exactly.
Because I think if you wait, you're going to lose money. If you wait to refi for lower rates, well, you could be saving $300 a month right now. So if it takes you 6 months to save $500 instead of $300, you just threw away $1,800 by paying extra payments to wait when you could have just saved $300 now, $200 later, and no additional cost.
To that same sentiment, you're literally losing money by not coming up with a plan right now and executing.
Yeah. Whether it's a purchase or a refi, doesn't matter. So I think it's like who's willing to execute is who's going to win.
I love it. Sweet. Well, anything else you want to cover with this? Any other predictions with 2026 we missed?
My prediction is whatever you predict is probably wrong.
There you go. Amen to that. Sweet, guys. Well, thanks for joining us.
Teej, thanks for putting a rock star topic together.
Let's do it.
Everybody, please comment. Any comments you have, we love to hear the feedback from who's viewing. We want to understand what your thoughts are, what your curiosities are. Be sure to like this video, share this video, subscribe to the page, anything you can do to help us. We are looking to grow this channel through 2026 and beyond. So thanks for tuning in.
Thanks for listening to the Loans Elevated podcast. For more resources, tools, and market updates, visit loanselevated.com. Don't forget to follow and subscribe for next week's episode.